Hi, today we're going to talk about FX basics or foreign exchange basics. So far we talked about other asset classes like equity, fixed income, commodities, where our product was some financial assets or physical assets like in commodity. But in this case, the product itself is a currency. So this is a market where the currencies are bought and sold, and the currency which we are talking about, which is a product, is a base currency. So there are two two notations or two popular ways to code the base currency. First one is a direct code. In direct code, the base currency is is put it in the denominator, and it is expressed in terms of price currency, and this is the most popular mechanism. And in our curriculum we mostly gonna concentrate on the direct code. The base currency, in some examples or prior year questions, it's also called the foreign currency, and the price currency is also called the domestic currency. In indirect code, the base currency is shown in the numerator, whereas the price currency shows in the denominator. But now onwards, we will focus on only on the direct code. So there are two markets. First one is spot market, and another one the forward market. So spot market is a market where we can instantly buy the base currency, like current price or today's price of buying a euro in terms of dollars. So euro is our base currency, and in terms of dollars, so dollar is the price currency. In this example, the spot price is given. In this example, euro is a base currency, AUD is the price currency. So we are saying one a Australian dollar. So sorry, 1 euro is equal to 1.3189 Australian dollar. What is forward market? So um, there are different. There are many buyers and sellers in foreign exchange market, and they want to they want to hedge their uncertainty. So they may be receiving payments in the future, they may be making payments in the future, and since these prices are going up and down, they're fluctuating, they want to cover themselves from those fluctuations. So they get into an agreement at a predetermined price sometime in future, which they mention in a contract, like after 3 months or after 6 months or after 1 year, I will exchange uh, X amount of euro at this much AUD price. So that's an example of a forward market. And most of the time, these forward rates are given as points. And the way to calculate forward rates is like subtracting or adding, depending whether it's negative or positive, to the last decimal point. So in this case, the point is given as -9. So the last decimal point is 3189. So 9 is the last decimal point. We subtract this point from the last decimal point. So this is our forward exchange rate. So we talked about uh, briefly, they are buyer, they are sellers. So who all are these buyers, who all are these sellers? So most of the times, they are large multinational banks, they have large inventory of currency. Those called the sell side. They are kind of they are speculators, they have view about what this currency will be after 3 months and 6 months, say. So they trade, and they try to make profit by buying the currency at lower price and selling at a higher price. So those are sell side parties. The buy side parties are like a multinational corporations who have operation in multiple currencies. Their investment account, like pension account or hedge fund accounts, who are operating, who have exposure to a foreign exchange transaction, or government or sovereign funds who want to exchange their currency, they have exposure to foreign currency transaction, or retail market participants who have exposure to foreign currency. So those are kind of customer. So these big banks, they, as I said, they buy the currency at lower price. So let's just talk about the base currency. So they buy at a bid price. That's the bid and ask, are the popular prices in on which they quote the currencies. Like these sell side participants, they quote the currency in bid price and ask price, and the spread is the profit which they make. So bid price, they buy the currency at the bid price, they sell the currency at the ask price. So since the ask, in case of base currency, the ask is greater than the buy, so they make the profit. And when the price taker, when we're talking about customer, when they have to sell the currency, they always sell it at the bid price, because their objective is not to make a spread. Their objective is to hedge against any unwanted fluctuations. So they sell it at the bid price, and they buy the same base currency at higher price. Vice versa for the price currency, we have it here. Thank you.